When capital stops waiting, why $242 billion chose Toronto. This wasn't a political gesture. It was a market judgment. In December 2025, one of the world's most conservative infrastructure investors opened a major office in Toronto. Not after uncertainty eased, not once trade policy stabilized, but right in the middle of elevated volatility across North America. That timing matters. To see why, consider the timeline. Through late 2024 and into 2025, markets were processing repeated tariff threats, conditional trade signaling, and abrupt reversals that made long-horizon planning harder to model. By mid-2025, that uncertainty hadn't resolved. It had accumulated, and in December 2025, right at that peak, IFM Investors made its move. IFM manages roughly approximately $264 billion in assets, depending on the reporting date. This is pension-backed capital designed to fund retirements decades into the future. It cannot tolerate prolonged stop-start policy environments. It prices uncertainty differently than short-term money does. So when IFM announced the opening of its Toronto office in December 2025, the signal wasn't subtle. It suggested that Canada was being treated not as a peripheral allocation, but as an operational base for long-duration infrastructure investing. Here's the point most surface coverage misses. This wasn't about Canada winning an investment competition. It was about capital deciding it could no longer afford to wait for clarity elsewhere. Infrastructure capital doesn't move on impulse. It commits to assets that must perform reliably for decades. Ports, power systems, transport corridors, utilities, digital networks. When that kind of capital chooses where to place people in operations, it's making a judgment about where predictability still exists. This video isn't about celebrating Canada. It isn't about criticizing the United States. It's about understanding the mechanics of how capital behaves under sustained volatility, and why, in this case, it stopped waiting. Because once capital starts building parallel routes, those choices don't unwind quickly, and that changes the math. To understand why this move matters, it helps to be clear about how long-horizon infrastructure capital evaluates risk. For pension-backed investors, volatility isn't background noise. It's a structural input. Assets like ports, grids, pipelines, and transit systems are financed on timelines measured in decades. Their returns depend less on quarterly growth spikes. They depend more on regulatory continuity, on stable trade relationships, on policy frameworks that persist across political cycles. When those conditions hold, risk premiums stay contained. When they don't, capital reacts. In 2024 and throughout 2025, trade policy in the United States became increasingly difficult for long-horizon investors to model with confidence. Repeated tariff threats, conditional trade signaling, and abrupt reversals introduced a layer of unpredictability that markets could not easily discount. This doesn't mean tariffs automatically scare all capital away. Shorter-term money often adapts. But for infrastructure investors, persistent uncertainty functions like friction in a mechanical system. It raises the cost of capital. It shortens planning horizons. And over time, it pushes investors to look for jurisdictions where those risks appear lower. Industry research and market commentary consistently show the same pattern. When regulatory or trade policy volatility increases, long-duration investors either demand higher returns to compensate, or they reallocate toward environments that appear more predictable. This is the midpoint anchor worth remembering. Volatility isn't a headline risk. It's a pricing input. When uncertainty persists, capital doesn't wait indefinitely for clarity. It builds optionality. It diversifies exposure. It looks for places where governments treat infrastructure frameworks as durable systems rather than bargaining chips. From that perspective, what happened in late 2025 becomes easier to interpret. IFM's move wasn't a reaction to a single announcement. It was the cumulative result of risk being repriced over time. And importantly, it happened while volatility was still elevated. Capital wasn't reassured by promises of future stability. It responded to where stability already appeared more likely to hold. So what changed on the Canadian side? The answer isn't one headline. It isn't one incentive. It's alignment. In its 2025 federal budget, Canada introduced a capital framework explicitly designed to crowd in private investment over time. According to official budget documents and analysis from the Parliamentary Budget Officer, roughly $280 billion in cash-basis support for third parties was framed as enabling more than $1 trillion in total investment over the 2025 to 26 to 2029 to 30 period. That figure isn't a guarantee, it's a framework. And that distinction matters. Enable doesn't mean the government writes a $1 trillion check. It means public capital is used to reduce risk through co-investment, through long-dated certainty, through predictable rules, so that private capital can deploy at scale. In practice, this is how large infrastructure systems are financed. Public policy lowers volatility. Private capital supplies volume. What caught investor attention wasn't the headline number. It was the structure underneath it. The budget emphasized multi-year predictability, long-dated infrastructure planning, carbon pricing certainty beyond 2030, expanded clean technology incentives, tighter federal-provincial coordination. Together, these elements signaled an attempt to reduce policy whiplash across electoral cycles. For infrastructure investors, that kind of alignment is rare, and it is valuable. When roads, ports, energy systems, and industrial supply chains are treated as strategic assets rather than tactical levers, uncertainty compresses. Risk premiums fall. Capital can model returns with greater confidence. Critics focused on what the framework didn't yet deliver. Markets focused on where it was heading. Compared with an environment where tariffs could be dialed up overnight, Canada's unfinished but predictable setup appeared comparatively safer for capital designed to operate for decades. This is where scale becomes less important than reliability. Canada didn't suddenly become a larger economy. It positioned itself as a steadier one for a specific type of investor. That is a different competitive axis, and it matters enormously for infrastructure capital. From a market perspective, this wasn't about ideology. It wasn't about branding. It was about probabilities. Where is the likelihood of policy continuity higher? Where is the risk of sudden reversal lower? Those questions drive capital allocation decisions long before any ribbon-cutting ceremony takes place. A common counter-argument appears here. Canada is still smaller, still exposed, still tied to larger neighbors. Why would patient capital treat it as a base? The answer isn't size, it's reliability. IFM is not hot money chasing yield spikes. It is owned by Australian pension funds. It invests on behalf of workers whose retirements depend on stable, long-term return. When it establishes an operational base, it does so to manage assets expected to function reliably for generations. Its existing Canadian exposure already reflects that philosophy. IFM holds stakes in core infrastructure assets that underpin daily economic activity. These aren't optional components of the system. They're national arteries. Opening a Toronto office wasn't about optics. It was about proximity to deal flow, to governance, to long-term asset management. In a jurisdiction that treats infrastructure capital as a partner rather than a bargaining chip, timing matters again. The decision came at a moment when many assumed Canada would absorb trade pressure passively. Instead, Canada had been quietly broadening its options, diversifying capital sources, emphasizing domestic processing, shortening supply chains where feasible. That doesn't eliminate exposure to global shocks, but it reduces dependence on any single channel of leverage. For an investor like IFM, that kind of positioning lowers downside risk. It doesn't promise higher returns. It promises fewer surprises. Markets understand that distinction very well. When multiple investors start making similar calculations, the pattern becomes visible. Even if it doesn't dominate headlines, capital doesn't announce regime change. It reallocates quietly. So what does this actually change? First, it raises the cost of volatility. When patient capital begins building parallel routes, pressure tactics lose effectiveness. Leverage only works when alternatives are limited. Second, it reshapes how competitiveness is priced. For long-duration industries tied to infrastructure, energy, and manufacturing, stability increasingly functions as a competitive advantage. It shows up in lower financing costs, in clearer site selection decisions, in more durable investment timelines. That doesn't mean tariffs disappear. It doesn't mean political cycles stop mattering. But it does mean prolonged unpredictability carries compounding costs. Once capital commits people, systems, and governance structures to a new base, those investments tend to persist. They don't unwind every election cycle. They compound. This is why the IFM decision matters beyond the headline figure. It reflects how markets are adapting to an environment where clarity is unevenly distributed. Canada didn't attract capital by outspending larger economies. It narrowed the room for uncertainty. It made predictability legible. And for patient capital, that can be decisive. This shouldn't trigger panic. It shouldn't trigger triumphalism. It should prompt attention. Because capital has already adjusted its behavior. And those adjustments shape the next phase of economic competition, whether policymakers acknowledge them or not. From here, the cost of instability goes up. That's the line that was quietly drawn.